When the world prizes speed above all else, what happens to those who can no longer keep up? For decades, China's economic rise appeared unstoppable. The workshop of the world, fueled by precision, discipline, and sheer scale. Factories that never slept. Ports that hummed through the night. Prices that fell like clockwork, year after year, until foreign competitors simply conceded. It was a triumph of organization, planning, and manpower. A civilization transforming human effort into unstoppable economic force. But every triumph carries a shadow. And China's greatest advantage, its ability to produce more, faster, and cheaper than anyone else, has become the very weight threatening to topple it. Welcome to the Financial Historian, where money, power, and history collide. And nothing is ever as straightforward as it seems. China's story is the story of modern capitalism pushed to its limits, a system that rewards growth relentlessly, even when that growth undermines the foundations it depends upon. What happens when the largest economy on Earth drives itself into overdrive, when efficiency morphs into self-destruction? To understand that, we must return to the roots of China's economic miracle. In 1978, Deng Xiaoping addressed the Communist Party and shattered one of socialism's most persistent taboos. He declared that pursuing wealth was not shameful. It was patriotic. And with that declaration, he ignited one of the fastest economic transformations the world had ever witnessed. Overnight, farmers became industrial pioneers. The rural villages transformed into sprawling production hubs. Foreign investors, initially from Japan, then the United States, and later Europe, saw a golden opportunity. Abundant labor at minimal cost, and a government determined to facilitate growth. China introduced a series of special economic zones, experimental cities with exceptions to traditional rules. No bureaucratic bottlenecks, no ideological gatekeeping, no central planning interference. The mission was singular: attract foreign capital and drive exports. It worked beyond expectation. Shenzhen, a modest fishing village of just 30,000 people, mushroomed into a metropolis of millions. Within 20 years, the approach spread to every province, with each city racing to replicate Shenzhen's boom. Local administrations borrowed heavily and invested in highways, power plants, and industrial parks, all to lure factories. By the early 2000s, China was not merely growing, it was consuming global demand for everything. Steel, coal, copper, oil. Western companies struggling to compete relocated production to Chinese soil. If it could be manufactured anywhere, eventually it bore the label "Made in China." Yet beneath this meteoric rise lurked a perilous incentive. To succeed meant to underprice everyone else. Local governments vied for factories by cutting land prices, slashing taxes, and suppressing wages. Companies competed by shrinking margins, compromising quality, and trimming profits. Growth was the obsession. Sustainability was forgotten. The race to the bottom masqueraded as progress. For a time, it seemed inconsequential. The industrial machine was unstoppable. Millions of rural workers flooded cities annually, willing to labor 12-hour shifts for a fraction of Western wages. Factories operated continuously. Ports never rested. Western consumers reveled in cheap miracles. $5 to $300 smartphones. The illusion of endless abundance without inflation. Meanwhile, China's economy soared. But somewhere between the 100th mall and the 1,000th steel mill, the system began to strain. Growth became an addiction. Local governments needed revenue to service loans taken to fund more construction, so they expanded even further. By 2015, China's steel production alone surpassed that of the rest of the world combined. Entire industrial zones churned out goods faster than global consumption could absorb. Prices fell, not from innovation, but desperation. Factories did not slow when profits vanished. They intensified output, hoping volume could offset losses. It failed. That was when a new term surfaced, borrowed from the human world but now applied to economics: involution. Involution was no longer merely students or workers exhorting themselves for diminishing returns. It had industrialized, systemic form, entire sectors locked in zero-sum struggles for market share, where survival, not innovation, dictated behavior. Solar panels, electric vehicles, and batteries, icons of China's emerging economy, became arenas of this brutal contest. Dozens of firms, many state-supported, flooded markets with identical products, each undercutting the other. Margins evaporated, yet no one dared pause. In a system where output equaled legitimacy, halting production meant losing face. The cycle was self-perpetuating. Prices fell to maintain market share. Competitors followed suit. Profits collapsed. Wages stagnated. Consumers cheered temporarily, only to realize that cheap abundance came at the cost of long-term prosperity. Industrial involution had taken hold, a self-destructive loop, in which efficiency devoured profit and relentless production consumed purpose. Innovation was no longer the race. Survival through underpricing was, and in all such races to the bottom, no one truly triumphed. China's solar panels now routinely sold below cost. Electric vehicles accumulated in lots, waiting for buyers. Tech giants fought over the same shrinking domestic demand, even as their market valuations fell. Despite record exports, industrial profits plunged over 20% in 2024. When everyone competes to be the cheap, price becomes the only variable left to adjust. This was not capitalism in overdrive, it was capitalism devouring itself. And yet, history suggested it was not unprecedented. In the 2000s, overproduction in steel and coal forced Beijing to intervene, closing mines, merging factories, and laying off hundreds of thousands of workers. Short-term pain preserved systemic stability. 2 decades later, the entire growth model, not a single sector, faced the same challenge. Factories did not shut due to spreadsheets. They closed when political allowance emerged. In China, contraction was politically unrewarded. Motion was. Even running in circles counted as progress. Behind closed doors, party officials monitored falling profits, stalled wages, and mounting debt. Publicly, the narrative remained: produce more, grow more, believe more. If the industrial machine stopped, the illusion of prosperity would vanish. By the 2020s, China's efficiency apparatus had evolved into an arms race against itself. From afar, triumph persisted. Record exports, gleaming factories, and pipelines of electric vehicles and solar panels capable of powering continents. But internally, profit margins collapsed. The miracle no longer generated wealth. It merely recycled it, faster, thinner, every year. Economists term this overcapacity. In China, however, overcapacity was not a flaw. It was policy. Consider the solar industry. In 2023 alone, China produced more than twice the world's total demand for panels. Prices plunged nearly 40% in a single year. Companies sold below cost just to clear inventory. Smaller firms went bankrupt, yet the giants persisted. Their local governments required jobs, production metrics, and the facade of progress. Electric vehicles mirrored the same pattern. Over 100 Chinese EV brands competed for a domestic market, unable to expand. Each slashed prices to survive, forcing competitors to follow. Government subsidies intervened to prevent mass layoffs, but these only prolonged the cycle. More supply, lower prices, thinner margins. By the first half of 2024, industrial profits fell more than 20%, despite robust exports. Factories moved unprecedented volumes of goods and earned less per unit. National growth statistics remained positive, but quality eroded from within. Yet this was not merely failure. Much of it was by design. China had perfected weaponized efficiency. Subsidies preserved key industries long enough to crush competitors. Strategic monopoly outweighed quarterly profit. In solar, batteries, and electric vehicles, Beijing tolerated short-term losses to control the future. Billions flowed from local governments into factories, cheap loans, and tax breaks. The logic was merciless. Flood the market, undercut rivals. Wait. Western competitors, bound to short-term profits and shareholder pressure, could not respond. They folded. Once global supply chains relied on Chinese production, China could dictate prices, control terms, and dominate entire value chains. The playbook echoed past successes: steel, rare earth metals, shipbuilding, all underpriced until alternatives disappeared. But today, the stakes were unprecedented. The focus was no longer industrial commodities. It was the materials of tomorrow. Lithium-ion batteries, photovoltaic cells, electric drivetrains, arteries of the 21st century economy. In theory, this strategy was brilliant. In practice, fragile empires cannot sustain losses indefinitely, even strategically. When every sector assumed government support, efficiency became addiction. Firms ceased competing on innovation and competed on subsidies instead. Productivity merged with politics. The boundary between national strategy and liability blurred. Fiscal time bombs emerged in plain sight. Each yuan spent sustaining factories today borrowed stability from tomorrow. Eventually, someone had to pay. This was the tragic essence of the China trap. The approach that had conquered global markets now threatened the domestic economy. Loss became the currency of dominance, not victory. Economic collapse was not a result of diminished demand, but the collapse of purpose. Momentum replaced strategy. The system could not pause because each level depended on perpetual motion. Local governments required factories to service debt. State-owned banks depended on corporate borrowing to justify balance sheets. The central government needed continuous output to sustain the illusion of full employment. One weak link, one pause, and the chain unraveled. So production continued endlessly, even when growth no longer equaled prosperity. This is the political logic behind state capitalism. Growth falters. The state doesn't retreat. It builds more factories. Prices fall. They fall further. Hesitant private sectors are met with credit injections. Every imbalance is met with more imbalance. This is not irrational. It is survival. China's economy is not only an engine of wealth. It is an engine of legitimacy. Its social contract is clear. Keep growing, and the population will keep believing. That worked when growth raised incomes. It falters when growth merely produces cheaper goods. The paradox is stark. Industrial overproduction keeps global inflation low, yet depresses domestic wages and demand. The country that lifted hundreds of millions out of poverty struggles to improve the standard of living for those already lifted. Exported deflation weakens the global system. Western consumers once welcomed cheap goods, a gift that tamed inflation, stocked shelves, and sustained middle-class life. Now, that same abundance exports fragility. Western manufacturers cannot compete. Emerging markets cannot establish self-sufficient industries. The global cost of cheapness is stagnation. China did not invent this trap. History did. The pattern is as old as empires. Britain's coal once flooded world markets, driving prices so low miners could not survive. Colonies absorbed the excess. Japan's 1980s miracle faced overcapacity, deflation, and an aging, non-spending population. Rome's decline began with overproduction. Slave-operated estates produced grain that collapsed prices and bankrupted small farmers, the backbone of the republic. Every empire mastering efficiency encounters the same question. Can optimization pause without collapse? China's leaders understood the risk. That's why they spoke constantly of rebalancing, shifting from investment-led growth to consumption-driven expansion. But rebalancing demands time, and time is a luxury a system addicted to growth cannot afford. While Beijing attempted to steer the economy toward innovation and domestic demand, provinces continued erecting factories, expanding infrastructure, and producing relentlessly, compelled by their local incentives. It was akin to trying to diet while the kitchen cooked non-stop. Ironically, many of China's most overproduced goods, solar panels, batteries, electric vehicles, are precisely what the world requires for the energy transition. Yet when prices collapse and companies fail, even global green initiatives stall. The rest of the world acquires technology at bargain prices, but China sacrifices profitability. Cheap abundance becomes a trap, not because wealth is not created, but because the motivation to create more is undermined. Efficiency, once a virtue, morphs into a disease. China does not lack productivity. It has too much. The empire has mastered production, yet lost balance. Capable of flooding global markets but unable to generate sufficient domestic demand for profit. A cruel symmetry emerges. The very force that built China's wealth, relentless competition, ensures no one can rest long enough to remain prosperous. Growth becomes identity. Production replaces purpose, and progress is measured by how cheaply goods can be made that no one needs in excess. This is industrial scale involution. Like every empire before it, China is learning that there is nothing more costly than being too cheap. Consider the consequences. Solar panels sold below cost, electric vehicles accumulating in unsold lots, technology companies battling over a shrinking domestic market while valuations drop. Export volumes rise, yet profits diminish. This is the economic paradox of overcapacity, reinforced by policy. Factories do not close due to market inefficiency. They close when political permission is granted. In a system where production equals legitimacy, stopping is not an option. Local governments, state banks, and the central administration are all locked into continuous output to preserve employment, social stability, and the illusion of prosperity. Subsidies and cheap loans have become the oxygen of industrial life. The longer the cycle continues, the more it replaces innovation with political maneuvering. Firms cease competing for excellence and compete for government support. Strategic loss, once a tool for global domination, now threatens domestic stability. Every yuan spent to maintain factories today is borrowed from tomorrow's solvency. Eventually, the bill must be paid. The same strategy that once enabled China to dominate global markets now risks consuming the economy from within. Industrial collapse is rarely triggered by declining demand. It is triggered by the collapse of purpose. In China, momentum has replaced strategy. The system cannot decelerate because every level depends on perpetual motion. Factories operate to service debt. Banks operate to validate corporate borrowing. Governments operate to sustain employment. One pause, and the system begins to unravel. Yet the illusion of progress persists. More production equals more growth, even when it no longer does. State capitalism enforces this logic. When growth weakens, build another factory. When prices fall, lower them further. When private actors hesitate, inject more credit. Imbalances are answered with repetition, not reform. It is not irrational. It is survival. China's economy is as much an engine of legitimacy as of wealth. The social contract is singular. Growth must continue for belief to persist. This worked when growth delivered rising incomes. It falters when growth produces only cheaper goods. Industrial overproduction suppresses wages domestically while keeping global inflation artificially low. Exported deflation spreads fragility across the world. Western factories fail to compete. Emerging markets struggle to develop. Cheap abundance, once a boon, becomes a trap. History has repeated itself. Britain's coal, Japan's 1980s miracle, Rome's overproduction. Empires that mastered efficiency inevitably confront the question, can they halt optimization long enough to survive? China now faces the same test. The empire has learned that in a system addicted to growth, the only thing left to destroy is itself. Because when efficiency becomes obsession and growth becomes identity, eventually, the system leaves nothing behind but its own fragility. Every layer depends on motion. Every decision reinforces momentum, and the consequences of pause ripple across the economy. Understanding this dynamic reveals more than numbers. It reveals strategy, risk, and the hidden forces shaping global markets. If this perspective opened a new window into China's industrial rise and its challenges, take the next step. Subscribe, follow, and watch closely. History is not just a record, it is a guide. I'll show you exactly where to look.